Hmm. Great.
So they can buy or sell an underlying asset at predetermined price and
Hmm.
predetermined time, means date.
Predetermined price and predetermined type.
Yes.
Okay. So do you have a demat accounts?
Yes, sir. Yes, sir. Yes, sir.
So this upcoming Thursday, so we'll meet around. What about your office timing? Tell me first.
11 to 9, sir. Morning 11 to night 9.
Night 9. So we'll schedule around 10:30. Okay. So is it work from home
Currently, I'm
or
currently
work from
home, sir.
office?
Work from home, sir.
Work from home. So can we connect around 10:30 or 10?
Okay, sir. No problem.
So we'll connect, and meanwhile, if you can add, you know, 3 to 400 or maybe minimum 1,000 rupees to demat account. So we'll learn the derivatives live from your account.
Okay. Okay, sir.
So did you activate derivative segment?
No, sir. No, sir.
Activate it meanwhile. Okay, just click on the derivatives, and that will take you to the next page and ask you to your mandate for activation. Just activate it. So you're gonna learn the important, which is future, right? Then FX
Yes.
contract, as well as you would learn derivative, options, put options and call options, right? Their premium, in the money, out the money, and at the money concept as well. So I'll cover that from a live account. Okay,
Okay, sir.
because this is a very important one, guys. This is a very important, even the margin as well. You should be aware about all this part. You're gonna be a part of an accounting teams. You're gonna be deal with or deal for all these financial instruments. So it means you should know each and every contract. And if you don't know, then you cannot resist in fund accounting business also. How the derivative works, how you can calculate the profit and loss, the treatment for a profit and loss. Okay, that all the terms are important. So I'm not provoking you to do trading and all, but I just want to show you
Okay, okay, sir.
something. Are you getting me? So I'm not
Yes, sir.
insisting you to do and uh, bet your money on a derivative contracts and all. No, because theoretically only, see, if you don't test it, then you cannot expect practical knowledge. What I believe.
Okay, sir.
If you buy it, then you would see the loss, right? Then you can ask me questions. So if you see the loss, then how can I apply the accounting treatment for this loss? If I see the profit, then you can ask me questions. So how can I apply the accounting treatment for this profit?
Okay, sir.
Maybe premium. So you can you can expect question in an interview as well. If I entered in put or call option, then what would be my total or maximum loss? You can also raise the question, sir. If I invest or if I entered into this contract, then what would be my maximum loss? Correct.
Yes.
So we'll learn a lot. We'll learn many terms, I would say. Okay. Anyways, so what do you know about swap?
It's a currency swap.
Yes.
Right.
Go ahead. Go ahead. It's a discussion, guys. Okay. Always you should you should discuss with me. You don't need to operate to anyone. Just be open. Discuss. I would
If any
like to.
European, if any European citizen want to get loan in European country, European bank,
Hmm.
they they have a some interest rate like 1%, 2%.
Hmm.
But any the foreign country like American citizen get it, get loan into European bank, they have a maybe difference interest amount like 3% or 4%.
Hmm.
At that time, the American citizen and European citizen came into one platform and they can exchange their
Okay, okay.
they can
Suresh,
exchange their
what about swap?
So exchanging of currencies or goods to from one person to another person.
Hmm.
Swapping. So it's called swap.
Dinesh, Suresh.
Yes.
Take the example of, see, if you want to execute any derivative contract, always you need to ensure that there is something which is called underlying security. Underlaying, it means what exactly, sir? Underlaying. We'll discuss that part. What is underlaying? So, what is underlaying, guys? How it's work? So, I'll walk you through that part first. Then maybe you would be in a better position to explain it. Even side by side, you can focus on writing part as well. See, derivative is not a new concept. Every session I several time highlighted this matter to all my clients. Derivative is not a new one. It's a very old concept. In past, we had a barter system, right?
Yes,
so
sir.
We used to do trades in goods. And Dinesh is here. And Suresh is here. Suresh and Dinesh. If you don't have a, if you don't have an underlying asset, then you cannot execute contract. So underlying asset, it means what can be the underlying asset? It can be anything. In a market, stock, goods, commodities, gold, silver, platinum, bonds, debentures, loans. It can be any interest rates, even weather, cricket matches. It can be anything. Those products which you can say, yeah, that would be your underlying securities. So how it's work? But that underlying securities. Let's take the example of Wipro stock. Current market price. So it means spot price. Sometime you would expect question on what is the difference between current market price and spot price, which is same. Spot price, it means the price which is buyer and seller are ready to trade. That price should be your current market price, correct?
Yes, sir. Yes.
But let's say the spot price or current market price of the stock is 420. So you have studied and and then you got to know the company's fundamentals are strong, and in upcoming time maybe this price can go up, correct, from the current market level to it can reach to the 500 or 520 level. It can reach to the 520 level, The duration, let's say maybe in next 3 months. See, if you don't have a study, still again you cannot enter into a contract. All these calculations will be happened in your mind, and then you wanna try to execute that with other counterpart who is interested. If you say the price will increase, so it means that would be your speculation, and vice versa. There would be counterparts so who can think exactly in a opposite direction. The way you are thinking that the price will reach to the 520, another counterpart will think price can go down and it can reach to the 320. Who is thinking that price can go down, he can sign the contract with you. If you think price will go up, right, from 420 to 550, because you are looking for opportunity wage, the 100 rupees price which you can earn from this contract. Are you getting me?
Yes, sir. Yes, sir.
And the another way, let's say arm is there, I'm thinking if the price goes down and if it reaches to the 320, then I'll earn 100 rupees profit. Both counterparts, seller and buyer, both has their own research, studies, speculation, right? And both they are looking for opportunity, earning opportunity. Both they are looking for earning opportunity.
Sir, counterpart means buyer and seller.
If you are buyer, then seller would be your counterparty. If you are a seller, then buyer would be your counterparty. Counterparty, it's just a name that it can be anyone. If you're selling something and there is someone who is buying your asset, then you would say that buyer would be your counterpart. Counter party.
Okay.
Party means the who is going to make a deal with you. Counter, it means furniture. On a counter, who is ready to buy that asset from you. Counterparty. So let's say, see, there are different types of buying security. Cash buy. Cash buy, it means you will have to pay full amount. Full amount of security if you want to buy it. That would be your cash buy. So in a trading term, we call this, which is cash and delivery. Delivery, it means when you paid the cash, then delivery happen. Right?
Yes, sir.
Another one is margin trading. So what is that margin? For 420 rupees, if you want to buy the 420 rupees security, then you can pay only 42 rupees as an initial margin. And buy that asset. This is the another way. If you, only you can pay 10%, right?
Yes, sir.
Which is 420. So this ratio is not a standard one. So that is depends on the security, because Wipro stock is a strong one. So where at least you will have to pay 10% as a margin, and then you can buy the security. Then who will bear the rest? Broker will bear the rest one.
Yes, yes.
Right? And broker will charge the interest on margin which you have opted. Okay, that's fine. Then what about others? If you don't have a margin, then you can pay premium. For a 420 rupees stock, you can pay 4 rupees premium and you can buy that stock. But when you pay the margin, when you pay the premium, right, at the time of maturity, so you don't need to worry about delivery and all. You just need to worry about the premium which you have paid. This would be your total loss. This should be your total loss. Why? If something happened with the trade, then maximum loss would be your premium which you have paid. Let's say price from 420 to if the price goes 416, then your premium will be 0, right? Then your total loss would be this automatically. But in case of margin, let's say if you take the example of margin, let's say you paid 42 rupees margin to acquire 420 rupees asset, so which was 10%. See, 10% should be maintained at any cost. If the price goes above or price goes down, in both the cases, this 10% margin should be maintained. That's what we have a term which is M2M. So what is that? Mark to market. So what is mark to market? To calculate the real value of an investment. How we can calculate? See, when you buy this particular stock, then you paid 42 rupees, right? When the price was around 420. Are you with me till here?
Yes, sir.
If price moves from 420 to 416, then there will be change in margin then. Yes, no, maybe.
Yes, sir.
Here you paid 42, right? Let's say this amount was on first day of trading. Second day was a bad day and price tank, and it now the current market price is which is around 416. So it means there will be change in margin, and current margin would be in your account, which is, if you minus 4, then this margin would be around 38. Let's say on day 3, if the margin goes and reach to the 410, see, the price is changing. Due to that, there is a change in premium, or I would say yes, a margin which you have paid, and here the margin would be around only 38, 32, right? Due to the change in price, you are seeing the change in margin. Are you with me?
Yes, sir. Yes, sir.
This is your mark to market. This change we actually trace it. The price is totally linked with the margin or premium which you have paid. If the price moves, then premium also will move. If the price goes up, premium will goes up. Margin will go up. If the price goes down, then premium will go down. let's say on day 4th, the premium is around 500. Sorry, price is 500. Then your premium would be how much? 90 rupee change, right?
It's a 90.
Add the 90, then how much it would be? 122.
120.
If you see, there is a, see, in both the cases, the bank can or the broker can set the minimum limit. If you reach to the minimum limit, then you will have to pay the additional amount to bring the account at original margin rate, which is 42. This is how margin account works. And if you see the extra margin in your account, so here you can withdraw the margin also. Here you can withdraw it. Here you can book the profit. How you can book the profit? You can only keep the 42 in your account, because this should be a mandate requirement, and rest you can withdraw it. You can withdraw that, that's fine. And if you see any change in it, if again reach to this, then here you can add 10 rupees from your pocket, and then your margin will back at again original level, which is 42. If you see, the important is, so why we are discussing this part, because you should know that how the premium and margin works. Premium and margin works with price, market price of securities. If the price of securities goes up, then margin will goes up. If the price of securities goes down, premium also will goes down.
Okay, sir.
Any doubt, guys? Is it boring session or how it is? Because derivative, which is little bit tricky one.
Yeah.
Sir, actually, when price goes down or goes up, then margin will change.
Margin or premium will change. Both. See, premium that we pay in option tradings, and margin we pay in future and forward tradings.
Okay.
This is the difference.
So,
Some confusion little bit.
so actually, we clearly can understand when we gone through the practical.
Yeah, but you should know theoretical before
Yeah,
that, how it's work and all. Because this portion where you may expect an interview, and even while doing job, you will have to verify all these transactions in this way.
Okay.
Yesterday, how much was the margin available, right? Today, how much is the margin available? That's how you can apply the accounting treatment and all. Unrealized gain and unrealized profits, that would be depends on this term. That is the reason this one is a very important one. Okay. Anyways, so why we have discussed, now we'll discuss on that part. Now at least you know that how the margin and premium works. Correct?
Yes, sir. Yes.
Okay.
So the premium will depends on.
Price. If the price up, then premium will goes up. If the price goes down, then premium will go down.
Okay.
See, there are different ways, so don't worry about it. Just at this point in time, just keep understand one concept in mind, that premium and margin that works with the price. If the price goes up, margin will goes up. Price goes down, margin will go down.
Okay.
Okay,
Okay. Sir.
Suresh. Okay, so now I'll take you here back with this. Now you know that the term which is margin and premium. Let's say you both have decided to enter in one, swap contract. Why swap contract, sir? We'll discuss that part as well. So Dinesh is holding 1000 Wipro securities. Right. Dinesh is looking for, let's say, due to recession, maybe inflation. Dinesh is worried about. Dinesh portfolio is in profit, but Dinesh don't want to sell that portfolio. But Dinesh is again worried about how Dinesh can generate passive income from the portfolio. Then Dinesh met to the Suresh, and Suresh is Suresh is looking for something which is, Suresh don't want the ownership. Suresh don't want ownership of securities. Suresh only want the exposure. Gain exposure, it means gain and losses from the security. And Suresh is ready to pay fixed interest rate. Suresh is ready to pay fixed interest rate or interest payment. If we take the example 1000 equities into 420, how much would be the price? Total amount 4,20,000
Yes, sir.
or more than that?
And 4,20,000 only, sir.
So this is the wealth of current, as per current market price, or spot price. Dinesh is holding the wealth of 4,20,000, and Dinesh is looking for fixed return on 4,20,000 wealth. And Suresh is also looking for Wipro stock, but Suresh don't want to hold the securities. Suresh is looking for just an exposure. Exposure, it means gain and losses from the security. Let's assume this. Suresh is ready to pay 20,000 fixed amount to Dinesh. This one is a very interesting one, guys. If you try to understand this, then you wouldn't see any barricade while answering to anyone or explaining to anyone. I'm trying my level best to simplify this, and this one is a very complex one topic. Most of the people, they don't understand this. Suresh is ready to pay 20,000 to the Dinesh, right? And that would be like fixed amount on a yearly basis. So it means every year Suresh can pay 20,000 rupees to Dinesh, and Dinesh is ready to pay all the value and corporate action benefits on and above this value. And if you see the change in this value, see, this is a contractual language. Any change that will be belong to the Suresh only. And let's say both are agreed. Then your swap, if you are agreed with these terms, then you can execute the swaps contract. Sir, tell me what we are swiping here. Dear, the one which is Suresh is looking for exposure of your portfolio, Dinesh portfolio. And Dinesh is looking for 20,000 fixed amount apart from risk. Dinesh want to transfer the risk, portfolio risk, or pass on portfolio risk on whom? On Suresh. And Suresh is ready to take the risk. Apart from that, Suresh is paying 20,000 to the Dinesh. We'll take one example to explain this whole matter. Okay, now you know the price, which is 420. Price is very important one. Let's say this contract duration was, or contract duration is for 1 year. Quarter 1, quarter 2, quarter 3, quarter 4. Are you with me, guys?
Yes, sir. Yes, sir.
Okay. See, in a quarter 1, this should be your spot price or contract price, which is
For
420. Correct?
yes, sir.
Spot price will be your contract price at the time of beginning, and you are not going to pay anything here if it is a swap contract. Initially, no payout required. No payout required. So it means here no accounting required also. Okay, interesting. At the end of quarter, that is quarter end, here, the price moves from 420 to 480. Then who would be in profit?
Maybe Suresh.
Who won? Ramesh or Suresh?
Suresh.
Let's calculate it. Let's calculate and see. 480 minus 420, correct?
Yes, sir.
Spot price minus contract price would be your net value that you can transfer to each other. So now the Dinesh is calculating, from his side. So 480 minus 420 would be your how much? 60. Then 60 into 1000 shares. Am I right?
Yes, sir. 60,000.
60,000. Any question on this part?
No, sir.
No, sir.
Okay. Then we'll calculate the Suresh value. Now Suresh is going to be happy in this case. Suresh is going to pay only 20,000. See, swap contracts or forward contracts, they reset or settled. Here you would expect question, settled or reset on a quarterly basis. Why? Due to risk.
Yeah.
To change or to exchange the profit and losses on time to time, this is, I would say, one of the best way to avoid the risk or to prevent from the risk. At the quarter end, you got to know that how much is your risk. Then, if you can exchange it, then you would be in a better position to deal with the further risk. But at the year end, you got to know that you are due to pay, which is 1 CR. Then you wouldn't be in a better position to repay that. Am I right?
Yes, sir.
But on time to time, if you got to know that, okay, so this is your current liability, total liability that you need to pay, and if you settled it, then you would be in a better position. Both the counterparties would be in better position.
Yes, sir.
Then, uh, then Ramesh, Ramesh. Why I'm saying the name is his name? Ramesh. Okay. Then Suresh called to Dinesh and said, "Hey, hi Dinesh. See now, I want to transfer 20,000 to you. So can you please transfer my 60,000?" Then let's say the bank. Even though you can appoint one bank, right? You can appoint one bank who can manage your trades, who can manage your transaction. Okay, then you can call to a bank and say it, hey, hi, it's HDFC Bank. So you know the contract which is I had signed with the Dinesh, and now I can see the Dinesh is going to pay the extra amount to me. So can you please call to Dinesh and ask him to pay the remaining amount? If you actually transfer, then Dinesh will transfer 60 and Suresh will transfer 20, correct?
Yes, sir.
But instead that, you don't need to exchange in this way.
So only Dinesh will.
Only Dinesh will pay 40,000.
Yeah.
This should be your gross payoff. Here you would expect the question, what is gross payoff? This gross payoff will receive to the Suresh, and Suresh will be happy. Okay, this was for quarter 1. Still there are a few quarters remaining, so we'll take the example. Okay,
Okay, sir.
then again we reset the terms. See, every time you can reset the terms, or you can again roll out these terms. If you keep the remain same terms, then you would say roll out the same terms. And this term also means to extend the contract. This term would be roll out the contract. Then let's say here the price was again 480. When we reset the contract, because your contract will be reset here, right? So which new terms and conditions which you can define, and here the one more change, which is the new change which would be here. You can calculate, means I'll take you to the next screen and we can calculate. So in a first quarter, price was 420, correct?
Yes, sir.
But next quarter, in a quarter 2, the price, if you see, which is 480. So you can set up or reset the contract for 480. So it means contract price would be, or Dinesh entire portfolio size or value would be around 480 to 480 to 1000, 4,80,000. Now contract will be signed on this amount for next quarter, for quarter 2. Why? Because Dinesh already paid. Amount from 420 to 480, right?
Yes, sir.
Dinesh already paid amount from 420 to 480, so he paid already difference to you, and Suresh received the difference as well. So it means after the quarter end, new contract will form with this, and this should be your contract price. And one more things which we can add now here. So Suresh is not ready to pay fixed amount, which is 20,000. He said he cannot pay the which is fixed 20,000. Instead, that Suresh is ready to pay the market rate on contract value. So what is
So
that?
after end of the quarter one, they enter into new agreement or continue with same agreement.
Depends. That's what I said. It's a depends. If they want the agreement with the new terms, they can form the new terms. If they want like same contract, then they can roll out the contract only. That's what it's a customized contract, guys. Swap, it means it's swap, or forward, it means it's a customized contract. That is depends on the counterpart.
Yes.
You both are friend. You decide. Why should I interfere in it? If you want the same terms and condition, you can go ahead with that. If you want to change the terms and condition, then you can change it.
Okay.
But in in a different examples, I'm covering the different terms, so which you should be aware about. That's what. Then here, the Suresh is ready to pay that is rate, which is market rate, right? Market rate, or which we can say RFR. RFR, it means risk free rate on market value of a securities. So it means on this security, this value, on this value, Suresh will pay, let's say, 10%. How much would be? 48,000.
Yes, sir. 48.
Then even though Dinesh is also happy, because now Dinesh is going to receive 10% on his portfolio, right? And
Yes.
in last quarter, Suresh also earned very well, which is up to 60,000. Then unfortunately, what happened in a quarter two, the price went down from 480 to 380. This is your quarter end price, spot price or market price. Now in this case, tell me who would be in loss?
Suresh.
Suresh. How?
Because the prices went down.
Go ahead, you are right, go ahead.
So Suresh has to bear the loss.
No, sir. Actually, they agreed on the agreement. They will pay on. Suresh is agreed to pay on the market value.
Yes. See, along with that, guys, if you see the terms of the contract, Dinesh is ready to pay all the value, right? Which will be on and above this 420. Apart from that, Dinesh is also ready to give you the corporate action benefits as well. Maybe let's say dividend. It can be anything. It can be interest payment. Dinesh is also ready to pay you that also. And in exchange of that, Dinesh were looking for maybe 20,000 amount. But apart from that, see, in any case, Dinesh want the value back, which is 4,20,000, and that's what the last statement here. If you see the any change in the amount, that will be belong to the Suresh only. And if you see here what happened, price went down from 480 to 380, We'll calculate the losses first. Quarter 2. Original contract value was 4 lakh 80, right?
Yes, sir.
But now if you see 380 into 1000, it means 3 lakh 80,000.
Yes.
First of all, Suresh will have to bring that value back at 480, right? Then Suresh will pay the amount. See the calculation here, guys. Now Suresh is in a big trouble in this case. Suresh will pay first of all 48,000,
Yes.
which is this part. Apart from that, Suresh will pay 1 lakh extra. Why? To bring this investment back at 480. This portion contract was signed on this amount, contract price. Suresh, are you getting me? Don't worry, you are not in a loss.
Yes, sir.
Don't go in depth. Okay, so here in this case, Suresh will pay 48,000 as well as 1 lakh, and investment will bring back at this, or contract value will bring back at this. That's how this contract will reset, and you can do the accounting for this contract on time to time. When you reset the contract, reset it means to settle the contracts on a quarterly basis to know the realized profit and loss from the transaction. If you see any question on this part, you can prepare this one example, sweet or simple example, and you can explain it to anyone. Can you prepare the example for me, guys?
Okay, sir.
Okay, so you will have a 1 week time, or maybe you can after the session you both can sit together, right, and create one hypothetical situation where you can sign the contract with each other and sign the contract, and then see the price movement. I'll take one more example with a corporate action benefit, and here in this case I'll give some benefit to the Suresh. Okay, so if you see the price here 380, then contract the next for a third quarter you can reset the contract price, right, and the contract price should be 380, correct? Yes, no, maybe.
Yes, sir.
So let's say this was the contract price, and price moves from 380 to almost 1. How much profit that you are looking for, Suresh? Tell me. 1 lakh, is it okay for you? 380, then I would say, let's say 500.
Yes, sir.
Here at the quarter end, price reached at 500, and this would be a spot price. Here now you're going to calculate the profit and loss. See, the other terms should be remain same, but here the interest payment which the Suresh will pay to the Dinesh on this amount, right? Because this was the contractual amount. 3,80,000 into 10% divided by 100, 38,000, which is Suresh will pay, which is fixed. But if you see the profit and loss, in third quarter, let's see who had been profitant. The price moves from 380 to 500, so it means 500 into 1000, the price will goes around 5 lakh, correct?
Yes, sir.
This is this total exposure as per the market price and contract price, contract price.
380.
380 into 1000, 3,80,000. Total difference
1 lakh 20.
1,20,000. So this difference Dinesh will pay. Dinesh will pay to whom?
Suresh.
Suresh. And let's say Suresh will pay, which is 38,000 to whom? To Dinesh. Apart from that, let's say during this period, company offered dividend, which is 10 rupees for per shares. During this quarter third, company offer corporate action, okay? And let's say Dinesh received 10,000, which is extra, because the dividend rate, if you calculate dividend price, 10 rupees for shares into 1000 would be 10,000. So which will be add in the value here, correct?
Yes, sir.
And if you minus this 38, so this benefit it goes around 1,30,000. So Dinesh will pay 1,30,000 to the Suresh, and Suresh will pay 38,000 to the Dinesh. But if you see, we cannot transfer directly this amount, so we'll always do the netting, right? Then 1,30,000 minus 38,000. So tell me the, I think 92,000 would be net, if I'm not wrong.
Yes, sir.
So 92,000 Dinesh will pay. Finally, Dinesh will transfer 92,000 key to the Suresh. See, this was like one of the part of this derivatives, and this was the part of the swap, and I would say this was like TRS one, total revenue swaps. Total revenue swaps, because Dinesh exchanged the revenue of portfolio with fixed price or maybe interest rate. That's how your derivative swap will work. And there are types as well. TRS, it means this was a part of total revenue swaps, right? Then tomorrow, so meanwhile, so I'll not cover entire things because you will have lot of doubts in your mind. So for me, I'll send you the document as well, but you will prepare the notes for with example for interest rate swaps. Okay, so we have covered TRS, total revenue swaps, and swaps we have covered. Right, swap, it means to exchange, guys. Exchange something, and it can be anything. If you are ready to pay 50,000 for per month, I'm ready to exchange my business profit with you. If you are ready, then tell me, I'll sign the contract with you. This would be a TRS. Then you will have to do some research on IRS with example, interest rate swaps, then principal swaps, okay? And apart from that, I also want you to do some research on commodity swaps also. Commodity swaps, write it down. This would be the part of assignment. Okay, I'll send you the document also if you want. I'll send you the document, this document, this one derivative copy. So I'll send you that. But I want you to be go through this all matter, right? Create one example and give me the example of that, IRS and all to me. I think I have already added it, this one. Yes, already I have added it. Go through it. Okay. See, the derivative is gonna be the very tough and as well as important element of your interview. Important, it means very, very important. So now you have 5 to 10 minutes. You can discuss your questions with me if you have any questions as such. I would like to answer your questions then, because I'm done with swap part. Right, I'm done with that TRS part as well. So I want you to be go through this all interest rate swaps, principal swaps, and commodity swaps by own. But I'll discuss about that as well. Tomorrow I'll discuss about that part also. But before that, if you do some research and study, then would be interesting one, right? Now you have an idea at least how this contract will work, how it will reset, right? How the margin works. So here initially in this contract we did not pay any margin, right? Then there is no accounting treatment required. Later on we received the cash flows. Then how we can apply the treatment to that cash flows? There would be a number of things. Think from that aspect. Look at a larger picture. Create one agreement that Dinesh and Suresh, you both gonna sign the agreements. Sign the agreements for, let's say, Dinesh also taken the loan, personal loan with a different rate, and even that Suresh is also taken home a personal loan from XYZ bank. But if you see that there is a difference in both the interest rates. Dinesh is paying fixed, which is 9%, and Suresh is paying which is 10, which is let's say floating, and then draft proper, write down all the terms and all with the conditions, durations and all, right? And let's say this contract, the IR is going to be settled on a monthly basis. Every month contract will settle because you pay the EMI monthly, right?
Yes, sir.
For a personal loan. So take this example and write it down the details for, or explain, I would say details for 3 months at least, 1, 2 and 3, and send it to me. This would be the assignment for you. Will you do that for me?
Yes, sir.
Okay. So any doubt on this part, guys? Was it helpful? I know that, see, the derivative I'm trying my level best to explain to you in a very layman way.
No, sir. No doubts for TRS part.
Okay. We picked 3 examples for TRS, total revenue swaps.
Yes, sir.
And
So forwards and futures and options are that is different compared to swaps. Yes.
they are from a same family here. See, initially in past we had a swaps, right?
Yes.
Then people were, I would say, they were in a need something again. The term should be more defined, and then that's what they now developed this forward. And again, due to counterparty risk, margin, payment, delivery, they were facing some challenges, and they entered into then they developed, which is forward. Future, where now the central parties or the institutions, they are in picture who take care of everything. And nowadays we have, which is again robust or very fast settlement contract, weekly settlement contract, which is your what I would say, options. Just because of time, margin and risk, on the basis of that, if you see the evolution, swap contracts had quarterly settlement, Forward contract had quarterly settlement, but again with a views counterparty risk, right? And then future will monthly settled, and your options will settle on a weekly basis. Every week the options will settle. We'll see that everything. Just hold on. This was like one of the type.
No problems.
Don't worry about it. So you will at least see, my target is at least you should understand 60 to 70% from the sessions. Then you can tackle the any questions which will be comes from a derivative side. 70% interview success part would be depends on derivative only. That's what we are focusing on, derivative. Okay.
Okay.
I'll send you this video very soon. Where is the recording?